Good afternoon, everyone. What I might do is just give you a very quick overview of myself and my background so you kind of get where I'm coming from, and maybe will help induce some questions later with regards to BrickX. So I'm from London, grew up in London, moved to Australia 2 years ago. When I left university, I went straight into investment banking for 4 years at UBS with a focus on the technology and business services sector. I think this is probably where my interest in tech was sparked from. I think the people founding tech businesses back 12, 13 years ago are probably no different to the people today. There's probably a lot more today, but super dynamic, very entrepreneurial, very inspiring. After 4 years of doing investment banking, which felt like about 10 years and probably was the equivalent of about 10 years in terms of a normal person's working hours, decided that it probably wasn't where I saw myself being in 10 years, and actually was about to leave to go and do an MBA at London Business School when my parents, who had a small little sports shop in northwest London that I'd worked in through the ages of 8 to 18, and actually through uni, through holidays, in terms of supporting and then ultimately managing so my parents could go away for holidays during the summers, said, hey, look, we've started this internet site. It seems to be getting a bit of traction, but it's actually kind of getting out of control. Can you come and help us? So I paused the London Business School thing for a year and said, sure, I'll come and work out what's going on. Had no idea what I was taking on, but essentially over a 5-year period from 2008 to 2013, we built an e-commerce business that, when I joined, was turning over about £500,000 to a business that we ultimately sold in 2013, which was turning over £35 million. Launched it into 8 different countries, and we sold 70,000 products, and we're generally shipping over 1 million parcels a year at the time that we sold it. Completed my service under the new owners of that business. Took a year out, which I thoroughly recommend to everyone to try and do at some point if you can. Did some crazy stuff. I'm sure everyone's got a bucket list of things they want to do, so don't leave it too late. And then arrived in Australia and was completely convinced, right, well, I know e-commerce, that's what I've been doing for 5-6 years. I'll come here and I'll go and work in e-commerce, start an e-commerce business, or go and find another business that needs turning around. I was pretty shocked at the state of the e-commerce industry in Australia, actually, and very quickly realised that it wasn't a very sensible place to be. As much as there were good opportunities, the reality of the industry was that Australians are pretty savvy buyers. All of the international businesses were targeting Australia pretty hard with their offering, which was basically outcompeting Australian retailers on price, on service, on just about every single metric. So if you wanted to basically buy something and you were happy to wait a couple of days and not need it in 3 hours, then there was no real reason for you to buy from an Australian retailer. And the infrastructure within this country just doesn't support e-commerce on a global scale in terms of the cost of delivery. In my previous business, which was a sports retail business, it was cheaper for me to send a pair of shoes from London to Sydney than it was from Melbourne to Sydney. And that kind of tells you everything you need to know about that. Now, Amazon coming here, it's super, super exciting. Will give the industry the much needed shake-up that it needs. Will force a lot of retailers to actually invest where they've been under-investing. And there'll be winners and there'll be losers. So I'm not here to talk to you about the e-commerce industry, but that hopefully gives you a bit of a background of who I am. I ultimately concluded that there were 2 sectors worth looking at where I thought there was significant opportunity for change, disruptive or innovative businesses within Australia without needing that international expansion piece, which adds a whole new layer of risk and complexity to a business that if you can have it without, great, and it can always be that option. And that was the property sector and the finance sector. My arrival at that thinking happened to coincide with me having fairly regular conversations with the BrickX chairman, the guy who founded it, a guy called Marcus Kalbetzer, and I guess it was a good combining of timing and skills that meant that I came on as a CEO. So I'm going to talk to you first about the fintech industry, We'll go through that quite quickly, just what I think and why it's exciting, but what I really think are our threats here. Then we're going to talk a little bit about why we even bothered founding BrickX, what we care about, some of the challenges that we've had, and some things that might be relevant for you guys if you're thinking about, or even in your current roles, or if you guys are thinking about doing startups. And then we'll talk a little bit about the success that we've had to date. We have been going for 3 years, even though we've really been in the public eye for about 9 months. We launched in September, but we'll talk about a lot of the stuff that's gone on behind the scenes there. So the first thing to say, it is super exciting time to actually be in Australia and thinking about fintech. The finance sector here is absolutely huge, and as I mentioned before, finance and property are probably 2 of the biggest sectors that are under disrupted in this country. In essence, innovation has always existed. The banks are always innovating. Whether you think it's good or not good, people are always evolving, businesses are always evolving, people are always causing that change to happen. But the reality is that the current the current tools that are available to some of our people, some of us that don't require us to work in big businesses, especially on the tech front, are actually making these industries more accessible than they have been previously. Now, fintech, because of regulation, etc., is a lot harder than other sectors, but it is easier than it was. The reality is that the banks are losing their oligopolistic grip on the market. They are having huge issues in terms of engaging with millennials. Not just the bank's faults. I mean, we've got a housing market here that has gone, nearly doubled in 5 years in Sydney. You've got a load of disillusioned millennials that think they're never going to be able to afford a house. If they're never going to be able to afford a house and they're not even trying, then they've got no need for a mortgage. If they've got no need for a mortgage, and it trickles down. So they've got huge issues in terms of trying to engage with a younger audience. We've got and that provides opportunity for those that are entrepreneurial and innovative. You've got a regulator here who, despite all the bad things that everyone says about them, I actually think do a pretty decent job. The fact that Australia is very heavily regulated means that essentially if you do have an ASIC license, there is a kind of mark of security or trust or credibility that for businesses like ours is pretty vital. And they are pretty explorative in terms of looking at new technologies, new types of businesses. BrickX, when they approached ASIC about 2.5 years ago, was the first business put into the ASIC Innovation Hub. And they, as much as we were trying to find our feet, they were trying to find their feet as well. And they still can, we still are continuing to work out how we evolve as a business. And the ASIC Innovation Hub is still working out how it's going to evolve and how it can essentially work with the innovative businesses of the future. They have since launched the Sandbox, and they continue to release research notes on pretty progressive technologies, progressive for Australia anyway, in terms of distributed ledger technology or blockchain, as others you might know it as. And then there are some wider rhetoric going on within the banking industry or the finance industry in terms of open data and other big initiatives that, again, I feel are quite, are definitely game-changing in an environment where you've basically had a cartel of banks controlling everything that we do with our finances. So why should we be worried? We should be worried in Australia about not actually taking advantage of the opportunity. The reality is that a fintech revolution is happening globally. The amount of money going into fintech businesses in the UK and the US is obscene. It's really, really well supported. And in Australia, we're really, really under-indexed. Part of the reason is that Australia just doesn't have a great track record of creating global technology-led businesses. You'll all know Atlassian, which is the one that always gets referred to. But if you think about those that have come out of the UK, Europe, and the US, you could probably name more of those than you can of Australian globally-led businesses, technology-led global businesses. Why that matters comes down to actually the funding in the first place. because for some of these businesses to be successful, they need really significant funding. And it's where is that funding coming from? Fintechs are rarely found in garages, and the reason that they're rarely found in garages is because actually to launch a fintech business, you need to consider legals, you need to consider compliance, you need to consider technology, you need to consider regulation, you need to consider marketing. And there's a whole raft of things that you just can't quite be as scrappy as you might be if you were setting up an e-commerce shop selling shoes. You make one mistake, and that's, if you've got a license and you're lucky enough to get to the point of getting a license, you make one mistake and that's it. There's no calling up the customer and begging forgiveness. If ASIC says, right, no more, then that's no more. So you need the expertise from day one, and that costs money. The people who have those expertise are generally, a lot of them are sitting in financial institutions earning pretty decent money, and whilst they may be willing to take a pay cut to come and work for a fintech, and for all the perks that we can offer in terms of equity, being able to wear t-shirts, flexible hours, whatever else it may be, they're not going to come and work for you for 65 grand or 70 grand a year. The other things that we should be worried about are that because of the money going into the UK, the US, Asia, Europe, and those fintechs, it's only a matter of time before those models come over to Australia. And it would be a real disappointment to not see Australian businesses take advantage of the revolution that's happening here and allow yet another international business come over and take advantage of that. Amazon are coming, I mentioned them before, Amazon are coming here now. Is it because they woke up one day and thought, oh, let's go and do Australia, that's an interesting opportunity? No, they've always known about the opportunity in Australia. It's just that it's actually been pretty low down the priority order, largely big land mass, small population, more interesting things to go after. The finance sector in Australia is quite different. That'll be very, very high on people's priority orders, especially because of the value of superannuation in this country, which is, I think, the third biggest pension pool globally. And the other reason that we should be worried is actually financial literacy levels in this country are abysmally low, really, really low. And I think that we all need to, all financial institutions should take responsibility in terms of trying to improve them, better educate our customers, because the reality is a better educated customer will continue to make better decisions, be more in control of their financial well-being, and for the better businesses out there, we'll all actually win off the back of better educated customers. So in terms of the BrickX story, we wanted to create a solution which allowed people to invest in residential real estate and access the returns, allow this for everyone without the pitfalls that exist within crowdfunding. We'll come up onto crowdfunding in a second, explain why we're not a crowdfunder. So why do I even care about it? Australian residential real estate is the largest asset class. It's worth 3.5 times more than the ASX. It's $7 trillion. That's a lot of zeros, so I wrote 7 trillion underneath for you guys. So again, still, why do I even care? Still, the only way to access the sector, quite unusually for Australia, quite unusually for the world actually, is that Australia has very few, or actually none that I can really find, significant investment products, financial investment products that allow people to access the returns of residential real estate without buying the property or owning the property itself. So there are no listed REITs that give you exposure to residential real estate. All the REITs are generally industrial and commercial. And the other thing you might want to care about is that the median Sydney house price is now over 1 million. So it's obviously fairly inaccessible for most people. And even if you do have the funds, it probably leads you to having a pretty undiversified investment strategy. But still, why do you even care? Well, this is probably the reason that you care, which is actually over the last 10 years and over the last 20 years has been Australia's best performing asset class from an investment perspective. And when you consider the people who've had access to these returns, or the people that haven't had access to these returns, that's what's caused a lot of the divide, a lot of the conversation around housing affordability, or the continued persistence of the conversation around housing affordability. It is a very, very popular asset class in Australia. It seems that the Australian dream has evolved from owning a house on a quarter acre block to owning a house on a quarter acre block and 5 investment properties. But this is the reason that we should all care, because it's actually about democratizing ownership and allowing everyone to be able to invest in the best performing asset class over the last 10 years, 20 years. Who knows whether over the next 10 years it will be the best performing asset class, but I'm sure it will still be very favourable. So coming on to BrickX and our story, what were we trying to solve for? So investing to access those returns, the historical or traditional way has been to buy the property, and that comes with many challenges. You've got affordability of your deposit and also all the costs involved in buying a property, so stamp duty, legal fees, buyer's agents if you use one, etc. You've got accessibility, and just the fact that actually it's a very competitive market. Lots of people spend a lot of time, don't factor the cost of that time into actually finding investment properties, traipsing through open houses to only lose out at multiple auctions. You've got tough lending requirements, which are seem to be getting even more stringent for investors at the moment. You've got lengthy investment holding periods. It's a very, very illiquid asset. It is an illiquid asset. And generally, most people are kind of forced into holding this for the long term. It doesn't make sense to sell it in the short term, especially when you consider all of the acquisition costs involved in buying it. And then it's expensive to buy and to sell, which is what leads people to holding it for the longer term. So in terms of our solution, just to remind you of this, what we actually set out to achieve is to create a solution which provides access to the returns of residential real estate investments for everyone without the pitfalls of crowdfunding. And so our solution here allows everyone to invest in property from prices under $100. You can do it really easily. You just go online, sign up, go online. If you know what you're doing, you can do it in 5 minutes. If you don't know what you're doing, it will take you about 10 to 15 minutes just to read all the education, etc. When you invest in a property on BrickX, you're actually investing into a trust, a unique individual trust that holds an individual property. So you choose the individual properties that you want to invest in. We've got all of the details on the site in terms of the cash flows, etc. Fully transparent. So you would benefit from the rental yield which gets paid to you monthly, also potential capital gains. There's no involvement in terms of managing the properties. We take care of all of that with professional property management. It's easy for you to be able to diversify because with bricks for under $100, if you want to invest a few $100s or a few $1,000s, you can easily split it across different properties, whether that's based on geographic location, whether it's based on properties with gearing or not with gearing, houses, units, etc. And then you've got control over when you want to invest, but you've also got control over when you want to exit, and you can list your bricks for sale at any time. So we do have in essence, a secondary market on the platform, and when you decide the time is right for you to exit, maybe you've been saving a housing deposit in line with the market and you've got your deposit's big enough now, or you're going on holiday and you've got a $10,000 investment and you want to just sell a couple of $1,000s of it, you can put your bricks up for sale whenever you want. So here's a little kind of graphical way of showing how this works. We go and buy properties up front, and this is really important to distinguish between us and crowdfunders. Crowdfunders generally go and identify opportunities and then try and raise funds to successfully exchange and complete. If you think about the Sydney or the Melbourne environment, where the majority of properties, or in Australia where the majority of properties are sold at auction, it probably won't go down too well if you get the winning bid at an auction and then you go up and say, I'm actually a crowdfunder, I'm going to put this onto my platform and maybe I'll be able to exchange and settle, maybe I won't. And so we take the view that for someone to sell to a crowdfunder, for a vendor to sell to a crowdfunder, because of the uncertainty of crowdfunding, he's going to need some kind of premium price to be paid for that, to take on that risk. So we actually think crowdfunding leads you to either overpaying for an asset or you end up buying a lower quality asset because you may be the seller of last resort, there be a buyer of last resort, there may be no other buyer. So BrickX actually has an underwriter, and we go and identify the properties that we want for the platform that meet our strict criteria, and we buy them up front, which means that when they come to our platform, everyone knows this is coming with certainty. The property's already been settled, already been exchanged, it's going to be settled, and so you can now pre-order bricks or buy bricks in any of these properties. They go into an individual trust. It's a fixed trust split into 10,000 units, and we call the units bricks. So in this example, the trust's got assets of $1 million, so a brick is worth $100. All the properties are tenanted, and we aim for them to be tenanted the whole time. We use professional property managers. Every month, let's say $5,000 rent comes in, we pay the water, the council, the strata, professional property management fees, etc. Let's say you've got $3,000 left after all of the fees. That gets paid out across all of the 10,000 bricks on a proportionate basis every single month. So the way this works is, imagine if you had your own house, you'd get your share of you get the rent every month. This is exactly the same, other than you get your share of the rent, depending on how many bricks you own in the property. You've also got the potential to earn capital returns. So every 6 months, we have an independent valuation of the properties, and that change in the value of the property equates down to a change in the value of the brick price, and we publish those independent valuations for everyone to see. It's important for 2 reasons. The first reason is that it helps you see how your bricks are performing in your portfolio when you manage your portfolio online. But the other reason is, for the last point, when it comes to selling, for you to be able to sell your bricks, there needs to be a willing buyer of your bricks. So when you go to put your bricks for sale, you do have full control over what price you're willing to sell your bricks for. But the publishing of that independent valuation essentially acts as a benchmark for where, if a seller prices it near there, a buyer should think that's pretty fair, and a transaction will happen much more easily than if a seller's trying to sell their bricks at a premium. If they want to sell their bricks at a discount, transactions generally happen very, very quickly. We'll talk a little bit about liquidity after. So we've created this easy-to-use platform. We've now got just under 6,000 investors. We started in September last year. We've got properties across Melbourne and Sydney. In July, we're going to be launching into our 3rd capital city. We've really put a big emphasis on customer experience, ease of use, transparency, and customer education. I think for one of the challenges I probably knew would be a challenge but could never continuously underestimate is how much education and how much hand-holding and how much transparency we need to provide to build trust amongst consumers that have never heard of us. And actually, if you think about it, it's quite a big challenge. You've got people coming to you, you've got a product, no matter how great your product is, people are giving you money, and all you're giving them in return is essentially an email receipt or some kind of form of confirmation. It's not like buying a pair of shoes online where you pay your money and the shoes come, and if they don't come, you can go speak to your credit card company or whatever it is. Here, they're giving you their money, a business they've never heard of before, and all they get in return is an email confirmation. So building, the more you can focus your experience around the customer, and the more you can do in terms of education, transparency, the more you'll be continually pushing yourself in the right direction to win more customers. So who is our audience? We've been well covered as potentially being the solution to housing affordability, which is a compliment I'll take, but I don't think we're quite there yet. The reality is we're not going to make housing more affordable. We will make housing investment in housing more accessible, but we're not impacting the cost of houses or units. But in reality, who are our customers? Our customers are essentially anyone that wants to invest in residential real estate that potentially doesn't have the funds to buy the entire property themselves, or actually chooses, even if they have got the funds, chooses not to buy the property themselves, maybe because they want to diversify, maybe because they don't want the hassles of actually running a property. So our customers range from the ages of 18 to 82, and in some cases they may be, the beneficiaries may be younger. And they range from parents who are actually starting to save a housing deposit on behalf of their kids, newborn kids, or however old they are. A lot of parents actually engaging with teenagers in terms of getting them to use the platform, helping educate them about how property works and how finance works, which we love and think that's pretty sensible. Students, so those entering the property market for the first time. For me, this is where we can really try and break this disillusionment that people won't be able to afford houses in the future. I think the younger we can get to people, that actually hard work, persistence will pay off. There's more ways for people to earn money now than there ever have been before. You can have your regular job, and if you really want to hit that goal of being able to save a housing deposit, you could be an airtasker in the evening. You can be an Uber driver on the weekend. There are a lot more options now. If that is their goal, we need to encourage people to go after that goal. They may have to reassess their options. Their first property may not be a unit in Point Piper or something like that. But I think the reality is that this disillusionment that exists is a big threat generally to the economy. Home intenders, so those saving a housing deposit, this is the first time that there's a product that essentially allows you to hedge your investment against the market. If you think about the changes in prices that we've had over the last 5 years in Sydney and Melbourne, even if you've been saving furiously, you're going to really be left behind given the increases that we've had there. And then we move on to more general investors. So those that have already maybe got their house, they're not using it for purposes of trying to get ahead and getting into housing, but actually they're using this as a way to diversify their investments, their current investments, so it can sit nicely along cash and shares as another option, obviously with them having the control to be able to diversify. And then SMSF investors, we're getting pretty good traction with the self-managed super fund investors. This allows them to be able to put meaningful amounts of money into high quality residential real estate without them creating an undiversified portfolio. So in terms of some of the challenges that we've had, and I'm coming towards the end, so I'm really happy to take questions from any of you after, and actually I hope the last kind of 20 minutes we can do that. Some of our bigger challenges, I've put simple on top, complex underneath, because that's a pretty accurate description of what we are. We try and make everything look really easy, customer centric, and seamless on the top, but the reality is this is a pretty difficult business to run, and as we grow we continue to evolve and get better at what we do. Regulation is an ongoing challenge. The thing I like about regulation in this country is it's very black and white, whereas a lot of the other challenges in our business, there are 25 different ways in which you can approach them, but with regulation, this is what you need to do, and we make sure that we need to do it. When you haven't got a license and you can't operate, getting your license is the biggest barrier. It's the biggest source of frustration, and it's an extremely large barrier that you've got to get over. Once you've got your license, then you love this, because actually it's the same barrier that's stopping everyone else coming after you. So I think the regulation in this country is great. It is pretty onerous, but I think the regulator's very well intended in terms of customer protection, especially for retail products, which is what we are. We are selling to mum and dad investors, and as a result, we need to think really hard around a lot of the provisions and the safety elements of our product. So in terms of those, actually, what did we think about? We thought about liquidity. We've got this secondary market essentially that allows you to put your bricks up for sale, and the median time that it's taken someone to exit their position from when they put a brick up for sale is under 6 hours, which, considering the illiquidity of the underlying asset and how long it takes you to sell a property, is pretty impressive. But actually, what if the liquidity isn't there? What if it doesn't work? Well, we've got exit provisions which allow 75% of brick holders to call a vote to wind the trust up, and every 5 years there is a compulsory vote across everyone, of which you need a simple majority of over 50% to decide whether we roll the investment on for another 5 years or we sell the property, wind the trust up, and return the funds to investors. Gearing benefits. We talked about negative gearing is a pretty hot topic in this country, has been for a long time. Our properties aren't negatively geared. The main reason being is that it changes the risk profile of our product if we've got to call funds in from investors every single month to continue the maintenance and the ongoing running of these properties. But we do have positive gearing in some of our properties. So some have no gearing, which are generally higher yields, income yields, and those with gearing can go up to 50%, generally doesn't go much above 40% because yields are low, provide for a greater exposure to the capital value of the property. We had to, and actually getting those loans, getting those mortgages which were provided by Macquarie Bank it took us almost a year, because although they are simple mortgages, the complex structure of our business of a trust sitting outside of our business with a sub-custodian and a custodian and a trustee and a responsible entity meant that all of the powers that a mortgage provider would have, where they essentially, if you default on your mortgage, they'll come straight after you, a lot of those powers are dissolved, and we had to work out the right way with the right and make sure that Macquarie's risk appetite or protection matched with what we wanted to achieve. Voting and investor empowerment, we're building a platform where essentially we're the facilitator. Think of us as being the equivalent of the ASX. We're not the ASX, but essentially we're trying to create a platform that allows people to be able to come and invest in residential property. We're market agnostic. At the moment, we're the ones that are bringing the properties to the platform. In a few years' time, we may not be the ones bringing the properties to the platform. There are many other ways that properties could come to our platform. So we're building the technology and we're building the platform around this. Being the facilitator, we need to make sure that we've got all of the provisions in there for protecting investors, such as voting and how does voting work. We're currently investigating using a pretty new voting system that's based on blockchain technology that's never been used before in the world within essentially getting votes within a financial services business or collecting votes within a financial services business as our solution. So everywhere we're looking within our business, we're looking for how can we actually find the best solutions that will work for our business whilst trying to be market leading in terms of technology, but not for the sake of technology, where it makes sense. And then also solving for valuations and data transparency. And again, solving for the valuations, you've got valuers here who are used to giving valuations for banks or for individual people. They all have their own liability insurance. And when you approach them and say, hey, I'd like a valuation on this property, which is going to be for potentially 1,500 investors and also for 30, 40, 50,000 other people that are going to see your valuation, a lot of challenges then come to the fore in terms of how do we get them comfortable that they're not going to have a mass lawsuit against them. And then in terms of
how do you do that? Or is that proprietary basket?
How do you do that?
Yeah.
A lot of these challenges we had before we had launched. And we had no market presence and we had no kind of momentum behind us. So the reality is you knock on a lot of doors until you find someone who's just not going to turn down the business. And they probably write you off as being a really small little thing that will never get much exposure, so it's nice business for them. And then when you start to get significant exposure, they revisit it because actually they need to reassess the risk. Even though you're actually clearly going to be quite a fast-growing client for them. So the reality is that you have to keep revisiting these relationships. And whilst we can manage our own risks, we have a lot of partners that will constantly want to manage their risks as well. I think valuations in this country are a huge challenge because the nature of evaluation is actually so subjective, and it's really, really difficult. Because we're not selling these properties every time we get a valuation, the difference between a valuer valuing something at 1.2 million or 1.225 million, if you were just getting a value on your property for your own superannuation valuation accounts, or let's say you were just getting a valuation ahead of thinking about selling, the difference of $25,000 may not, probably won't matter to you too much because there's going to be an action after it potentially. For us, the difference of $25,000 actually does matter because it's a difference about whether we say a brick is worth $102 or whether it's worth or $120 or $122.50, which then impacts a large number of people. So with regards to the valuations, we look at the market movements. We look at a lot of data to make sure that the valuations that we get are in line with roughly where we think they're going to be. But in the future, I think you'll see a lot of advancement in terms of how valuations are done in this business. CoreLogic and APM Pricefinder and HomeTrack and a couple of other businesses have got some pretty sophisticated AVMs, which stands for, I don't know, algorithmic valuing mechanism or something, or automated, whatever it is. It's an automated valuation basically based on all of the houses or units that have sold in the area, grading yours in terms of quality against theirs, etc., and gives you a valuation range. In some areas they are fantastic, and in other areas they'll give you a range of 1.2 to 1.8 million, which is completely useless for our purposes. So trying to find consistency is a real challenge. We're not the only people trying to solve this though, which gives me comfort because that'll probably be an area where we'll leverage the expertise of someone in the future. So in terms of launching a fintech, I think I've probably given you enough background here to kind of tell you it's not super easy, but actually with a lot of hard work and persistence, a decent amount of funding, and we're quite lucky that our founder was pretty passionate about this and happy to commit a lot of his own capital to getting us to where we are now. The challenges really are funding, regulation, finding the right team, validating your product, and that's kind of hard because it might take you a while to validate it, by which time you've already spent a lot of money, and then you've got to consider whether actually you're building something that's worth building or you're happy to rip it up and go, this didn't work. And then building trust and credibility. So, as mentioned, we've been live since September. We've now got 11 properties. We've got another one launching next week. We'll be launching into our third capital city in July. Approaching 30,000 sign-ups, which is converted into 5,700 investors. As with most businesses, we continue to look at a lot of metrics and stats around our business, so conversion rates and how we can influence those. The average portfolio is $2,000, and that will range from people who've got portfolios of $100 to those who've got $125,000. And I mentioned liquidity and the time to sell. In terms of trust and credibility, we've been really proactive in trying to find external points of endorsement for our product. We found really early on that where we, for instance, put up a Facebook ad saying the new way to invest in real estate or invest in real estate for under $100, people have actually become quite immune to those ads. There's so many property spruikers on Facebook. I think if any of you guys went through your feed, you'd probably struggle to scroll for more than a minute without finding 3 or 4 people trying to get you to a seminar on how to have passive income and how to retire in 5 years, and how someone built their property portfolio by the time they were 23, etc. And actually I think people have generally become quite anti that. So we found where we can get other people to talk about our product is much more productive and credible than where we're talking about our own product. And that comes down to winning points of endorsement or winning awards. So we were pretty thrilled this year to be the first ever fintech and startup to win a CanStar Innovation Excellence Award. I don't think we can probably get any better in terms of a brand endorsing us or endorsing what we've built. We've won a few other awards, and the one that I haven't actually put on there is that we got rated by SQM Research, which is a research house that focuses on property, alternative assets and equities, and we got rated a superior rating, 4 out of 5 stars, which for a first time of rating of such a young business was quite an achievement. So, and there's one other bit of news there. So if there's of any interest, we are actually about to grow the team from a small team of 13 to probably close to 30 people by the end of the year. hiring across all areas of the business in marketing, tech, strategy, compliance, ops, etc. So I'll just leave that with you guys.